Hey everyone, Dr. Johnny here, aka Jonathan with Anachi. I'm a part-time endodontist, full-time real estate fund manager, and I want to welcome everyone back to the channel today. Today I want to talk about something that almost nobody likes talking about, and that's risk. Everybody loves talking about returns, IRRs, equity multiple, tax benefits, but I believe understanding the downside is just as important, if not more important, as understanding the upside. Because every investment has risks. Quantifying and qualifying those risks is the job of a good investor. And Eastern Light Distillery is no different. This is our most current opportunity called Eastern Light Distillery. In fact, I think there are three primary risks investors should understand in this deal. And I want to walk through each of them. Not because they scare me, but because I think sophisticated investors deserve transparency. And on this channel, we try to teach people how to take a sophisticated approach to investing. And let's talk about this deal specifically. Now, risk number one is construction risk. Eastern Lights Distillery is building a world-class distillery from the ground up. And building anything is hard, right? You need to get financing, you have to acquire the land, you need the capital from lenders to start building, you need to raise equity. Construction delays happen. Unexpected costs happen. Permitting issues happen. I've invested long enough to know that things rarely go exactly according to plan. But here's the key. The company has spent years planning this project, right? They've assembled a great team. They have some of the biggest accolades in the industry, around the distilling industry, including Master Distiller of the Year. To help build a previous distillery for another very successful distillery. They spent decades of experience, the founders. They've raised all the capital they've needed to start building this structure, to start building the distillery. That's happening imminently. Senior financing is preparing to close. 230 acres of land have been acquired. So a lot of those boxes have been checked, right? Acquiring the land, lining up the investment proceeds, the investor proceeds, raising the capital, lining up the lending from senior financiers. So while the construction risk absolutely exists, that means now we got to actually go to the ground and build this structure. I believe it's manageable, and investors are being compensated for taking on this level of risk. Risk number two is execution risk. Building the facility is one thing, right? So now we built this brand new, beautiful, world-class distillery, one of the most state-of-the-art ones in the entire country. Now, operating it as a successful business is a whole nother risk, right? So this is the business of contract distilling. It's making a commodity of whiskey, which they sell onto speculators and buyers. And then, so there's the contract distilling, actually producing the whiskey. Barrel storage, whiskey, unlike other assets, actually increases in value over time, but you have to age this whiskey for several years to get different levels of quality and for it to be consumable. So storage, and that's separate business on its own. Aging process, having this infrastructure to age whiskey. Branded spirits, number three. And fourth is the hospitality part, right? So this is going to be world-class facility where people can come and visit, tours, etc. It's going to be a beautiful facility on a huge parcel of land. There are four different businesses, right? And execution of these arms of the business absolutely matters to investors and the bottom line. And this is why I spend so much time evaluating the people who are going to run the deal, right? You're betting on the jockey, not the horse. And here we're looking at the sponsors, the founders themselves. What is their business background? What is their investment background? What is their background in this particular space, in this industry? Right? So we want to know what relevant experience they have. Do they have honesty, integrity, transparency, right? Are these the type of people that we are aligned with? Because we're in for a long haul, right? It's a 5 to 8 year investment. So if you're looking at for that time period, you want to make sure that you have an alignment in values with these with these founders who you're investing in. All of this stuff really matters because I've learned something over the years. Great operators can solve problems, because problems always exist when anytime you're executing a business plan, whether it's operating a multi-family property or a self-storage facility or senior housing, whichever niche asset class specific you're in, whatever asset class you're in, you have to learn the nuances and understand how to navigate whatever happens in that specific business. Think about dentistry, right? A dental business. Very different from running a paving company, for example, right? So you have to, and great operators, when things happen, they know how to solve the problem. They know who to talk to. They have the capital, liquidity. They have the reserves that they can make things happen, right? Because I've seen great operators take a deal that went south for reasons out of their control and figured out how to make the investment still work, right? To save the deal. And I've seen really average to poor operators get into a great deal and never realize the gains because they just weren't, they didn't have the reserves, they didn't have the know-how, they didn't have the resources to get through problems, right? Average operators and poor operators, they make excuses. Great operators solve problems, and every business encounters problems. What matters is who's sitting in the driver's seat making the decisions when they do. And after spending time with Caleb and Cordell, the founders, myself, other fund managers, including fund managers that I know and respect, they've actually visited Caleb and Cordell in Kentucky, visited the site, seen for their own eyes, met these people. And I truly believe they're problem solvers. They're very intelligent. They understand the business inside and out. They've been in this distilling industry for decades combined, and that doesn't guarantee success still, right? Being the master distiller of the year, knowing the process, knowing how the business runs, having contacts in the industry, that helps us move towards being a little more certain, but it does not guarantee success. Nothing does. No investment has guaranteed success. But people, again, matter more than the projections, because hey, you can project this great return, but if the people that are executing don't have the capacity to make that happen, to make that deal happen, those projections are a dream. And so evaluating those people, I think we've checked those boxes, and that helps us to feel better about that section of risk. Now let's look at the third biggest risk that is probably the most overlooked, is the time horizon. This isn't a quick flip. You're into flipping houses, this is not the channel even for you, right? We're talking about building wealth, building cash flow, getting tax income, and ultimately building freedom, right? Freedom to make income and build wealth outside of our main career. This isn't something that you're checking your app every day, right? Building great businesses takes time. Point blank, period. Aging whiskey takes time. And frankly, that's one of the reasons the projected returns are so attractive, because patience is being rewarded. And I think that's an important distinction. A lot of investors want private equity returns with public market liquidity, right? They want home run returns and instant gratification. And usually you don't get both. But that being said, there is a short pathway to cash flow on this deal, I think at the end of year 2. And so it's not overly long before cash flows are projected to start, and they are very significant, in the 15 to 20% per year of cash flow after year 2. That's the projections. So there is a little bit of waiting time. But now, still, it's a long-term horizon, and that's what you have to keep in mind. So after hearing these risks, you might be wondering, so Dr. Johnny, then why are you investing? Well, I think I've explained it as I went along, but I believe investors are being adequately compensated for taking on those risks. Now, let's talk about the returns. Now, what returns for taking on development risk, execution risk, business risk, timeline risk? What do you think is a good level of return for taking on that? Right? We typically are multifamilies have very good returns at 15, 16, 18, 19% IRR. But a multifamily real estate deal has categorically a much lower risk profile than this deal. So that means the returns have to be much more attractive. Right? It makes sense. Taking on a high level of risk, you want a high level of return. And we were able to negotiate fantastic terms. Let's talk about it. For our Walk of Wealth general community investors, this is first time investors, This is for accredited investors only. Now, we're projecting for our general community members a 34.8% IRR. Yes, I said it, 34% IRR. 12.5x equity multiple. Yes, a $100,000 investment is projected to return a 1.25 million total return. Very good. And a 10.5% preferred return, which means that investors are getting a minimum of 10.5% per year, accrued and compounded, before there's a split with the sponsor, right? So that 10.5%, it comes first to investors before anyone else's, right? And it's only a $40,000 minimum. We lowered the minimum so more people, it's a little bit more of a speculative investment. So we wanted to lower the risk profile, lower the risk, and make the minimum a little bit lower. And for our Walk of Wealth Mastermind members, now you probably heard about us talk about our mastermind group. It's a group of very highly sophisticated dentists, real estate entrepreneurs. We come together, we look at deals, we do strategy, we invest together. If you're interested in learning more about that mastermind group, check the link below. I'm sure there's a link below where you can learn more about that. Now, if you want to become a member, now the members who are getting a 42.2% projected IRR, higher split. That's one of the advantages of our mastermind members. So they get a 42% versus a 35% to general community, and a projected 15.1x equity multiple and a 12.75% preferred return. So a little bit higher than the 10.5% preferred return for our general community members. And it's only a $30,000 minimum for our mastermind members. So very, very compelling return profile that goes along with the risk. So on a risk-adjusted return, I still think it's very, very high. Now, for all investors, added bonus is tax incentives. We are building a new construction, and thanks to the big beautiful bill, we will be getting over 100% bonus depreciation. That would be for the year 2027, that's depreciation. Now, let me be crystal clear. These are projections only, right? These are not guarantees. So you have to keep that in mind. This is an investment. But when I combine the projected economics plus the multiple revenue streams, the quality of the founders, and the progress made over the last 9 months, I believe the overall risk-reward profile is very compelling. And ultimately, that's what investing is. It's not avoiding risk. Risk is unavoidable. The goal isn't to eliminate risk. The goal is to understand it and mitigate as much as possible. Price it appropriately and decide whether the potential reward justifies taking it. And for me, I believe Eastern Lights very clearly does. If you'd like to hear directly from the founders, Caleb and Cordell, we recorded a webinar presenting all the specifics of this deal. I'll put the founder webinar replay and the investment deck in the link below. Take a look. Do your own due diligence. Talk to your advisors and invest thoughtfully. If you have any questions, feel free to schedule a call with me or one of my teammates, or shoot me an email. Send me a direct message on the Messenger. There should be a link for the Messenger app. You can link me directly on the Facebook Messenger. All right, guys, that's all I have for you today. I'm Dr. Johnny Withanacci. And remember, the goal isn't to avoid risk. The goal is to understand and qualify it. All right, guys, thanks for watching. I'll see you on the next video.